Okie dokie, got it. Okay. Donald's coming back, but this class is about investment properties, which have, in my opinion, still kind of stayed. There's a bit of prominence in the terms of what's getting sold and bought right now. There's a lot more investment properties, I feel like, than primary residences. So this is a very important class, in my opinion, for what's going on in the times. Next slide here.
It's easy to use the arrows on the keyboard.
Okay, great. So here's our current market. Rates went down at the end of last week, pretty significantly, actually. So you'll see that you're finding 30-year fixed rates in the, around the 6% range, which almost, less than maybe 2 weeks ago, that was closer to 7%. So we did see a huge drop in rates. It was because of a big reading on inflation came out, and it appears as though the markets feel like inflation is starting to get handled by the interest rate increase from the Federal Reserve. So we've seen, a nice bump down in rates on both the 30-year, the 15-year, jumbo, across all the board. Employment rates still at 3.7%. I put on there home prices stable and decreasing, rates starting to move back down, inflation starting to cool, stock market going up a bit. It went up pretty dramatically on that Thursday before Veterans Day. But the Federal Reserve is still most important piece of his mandate is cooling inflation. That's what they still think they're going to raise rates again at the next meeting. Not necessarily a 0.75% raise like they did last time, but rates are still going to go up because inflation still is high. It was at 7.7% on Thursday on that reading. They just expected 8%. So we're still high on inflation, but definitely getting better. And that's why you saw rates come down on Thursday. Okay, my goal here is for you guys, you don't need to know everything about every loan that I'm going to be talking about, but it's just, hey, at an open house, if you got someone that comes in that's an investor, you can speak, a little educatedly on some options here to get their head moving, get the wheels moving. Sophia, this thing blocks some of my presentation. Just drop it there. All right.
Coming in.
No, it's all right. I got it. So understand the different loan options, be able to market these loan options that are going to be our bank statement loans, DSCR loans, which is debt service cover ratio. There's cross collateral loans, which are a really cool loan that I'll explain, and then fix and flip and hard money. Those are primarily what you'll find when you're dealing with investors. Okay. So just to jump right in, just a quick little vocab here. Investment property. We get a lot of people, deciding whether they want to try to buy it as a second home or as an investment property. Investment properties are bought for the sole purpose of renting them out. It's a rental style purchase. We know that. The rates and the down payment restrictions are less restrictive on second homes. That's why a lot of people like to try to buy them as second homes versus investment properties. Second homes are getting scrutinized a lot more now because the market has realized that people were buying second homes and then turning them into Airbnbs and VRBOs and rentals. So the rates have now gone up on second homes to mirror investment properties, but it's still, second homes are able to be done with 15% down. And single unit investment properties as well are able to be done with 15% down. I'll get into that in a second. But basically, if the bank thinks you're going to rent it out, they're going to hold you to investment property rates and investment property programs. They'll snuff you out. Okay, so keep that in mind. Rates are higher because you're going to pay your single family you own that you live in before you're going to pay your investment property, right? So they definitely have higher interest rates on investment property loans. They typically like to see more down payment for the same reason. most people, when they're analyzing investment property purchase, they are just looking at cash flow, right? So they're, hey, does this payment, is it low enough to where I'm making some money every month? That's really their goal. It's a non-emotional purchase, right? Which is nice for you guys because you're having these buyers that come in, and it's again, strips the emotion out of it, strips a lot of the hard work of your job out of it, I feel like, right? The emotional side of your job is primarily the thing that will drive you crazy. So we do allow them to be vested in LLCs and in revocable and irrevocable trusts. Okay, that's a big one. For irrevocable trusts, we have lending options for that. The underwriting of the investment property, how it works, you know, a big component of it is that you get to qualify with the rental income of the property you're purchasing, right? They take an expense ratio on it. So if the rent is $4,000 a month for the property that you're buying, the bank gives you $3,000 a month of that to offset the mortgage payment, right? So if your mortgage payment is $3,000 a month and you're buying a place that has a rent or a lease at $4,000 a month, essentially it's as if you're not having any increase to your debt ratio there at all. Okay. Yes, Donna.
If you're buying a fourplex and it's all tenant occupied,
Yeah.
and let's say the total rents are $10,000, what's the percentage then?
75%.
75%.
Yep. They will do 75%, and they'll, depending on if they're leased right now versus if they're if they're vacant, they'll send an appraiser in there to do a rental survey. Yeah. So keep that in mind. Those things, I mean, they come back fairly accurately. I've found the rental surveys.
Okay.
They're not going to just juice up your rents though.
Right.
Right. So keep that in mind. A lot of investment property purchases, the loans are done on adjustable rate mortgages. We do a lot of them interest only, right? So keeping that payment low being the goal. Interest only, adjustable rates typically have, the adjustable rates typically have lower rates. The interest only is a lower style payment because you're not paying principal down over the month, right? So that's why we see a lot of those go on. And those are things that you should suggest to the investors. Hey, we can do these loans on interest only so that your payment is lower. Just keep that in mind. Alex has options for interest only loans for investment properties. Okay. Down payments, again, I pointed out here, they do allow 15% down on a investment property single unit. The rate is atrocious though, so it's not even worth it. The goal for investment properties is 25% down. That's where you're going to find your price break. So I wouldn't do it even with 20%, to be honest. Your rate is going to be so high. Probably like 1% to 2% higher than what it would be if you put 5% down. So the conventional loan, the limits went up over the last 3 or 4, probably the last month. So you can now buy almost a $1.3 million house with 20% down investment property if you'd like, even though it's the rates can be really high.
Quick question. So on the arms, so
Yeah.
you can pay interest only. So I understand, that's the short term.
Yeah.
What's the long term effect, on that?
I mean, the goal is to potentially either sell or refi once that interest only period is almost at
And that is the duration of.
7 to 10 years.
Oh, okay.
Yeah. So you buy yourself 7 to 10 years to be able to either refi, sell,
Or pay it off.
or pay it off, or extend the term, right? So you can come back in 5 years and then do another 10-year interest only. So essentially at that point, you've gotten 15 years of interest only.
So would that be something you would consider, to an investor that's looking to purchase property, hold, renovate, and then throw it back out?
Totally.
Okay.
Yeah, I do interest only all day long on that because your payment is minimal or it's much lower than what it would be principal interest wise. 100%. And a lot of those fix and flip style loans that we'll talk about, those are all done interest only. A lot of the hard money loans, those are done interest only. And they're done like balloon style payments where it's, even like a year with no payments and then you just pay when you sell. So it just, it totally depends. these aren't really for, besides that fix and flip, these aren't really for the person that's buying, holding for 2 months and then selling. These are more for people buying, holding for 5 to 10 years and then selling. And 1031ing into a bigger piece of property. Okay. The bottom ones are obviously the more important ones. We like to sell more expensive homes, right? A lot of the bigger banks, a lot of places don't like to do investment property loans. A lot of like B of A, Wells Fargo, Chase, they don't really touch investment properties, or if they do, you got to put like 40 to 50% down on them. Okay, so we have access to lower down payment jumbo loans for investment properties. It's very important. You obviously want those clients, right? And if you find those clients and they can put less cash down as long as that property, the rents are high and it smashes a bit, keep that in mind. Hey, 20% down to 1.3, 25 to 4 million purchase, 30 to 7 million purchase. When you have those big open houses, Lawrence, that's now, we can put down less amount on those. Okay. All right, here's the loans. We're getting into the bank statement versus the debt service cover ratio. These are, again, for people that are fuzzy on their taxes, right? Like a lot of the time when you are dealing with investors, you're dealing with people who are not reporting their income properly on their taxes. They're winning on their taxes. You can't win on your taxes and on the mortgage. Okay, that's something I always say. You're either going to get hosed on the rate because you write off all of your income, even though you're making a lot of money, or you're going to get hosed on taxes if you claim all the income. So these loans are for people that are taking advantage of the tax side of things. The bank statement loan is really cool. It just uses your bank statements. Let's say you're getting 1 month you get 10 grand, the next month you get 15 grand, the next month you get 5 grand. They just sum all of those deposits up and that becomes your income. If that's going into a personal bank account. If it's going into a business bank account, they sum it all up and they take an expense ratio of your business expenses out of there. Typically like, 50%, somewhere between 25 and 50%. So it's a bit of a hit. But these are, again, great options when someone comes to an open house and says, you know what, I just don't want to deal with all of the paperwork. I don't want to show my taxes because I don't claim a lot of income. Well, here we go. We have alternatives for you. We have bank statement loans for you that we can do. The rates are higher, right? They're going to pay a premium for these, but they work. They totally work, and we do them on a pretty regular basis. The debt service cover ratio is a loan that I've done a few times for a couple of agents in the office. I did one recently for Pat Casera. His client loved it. Okay. That one is even less intrusive to the client's financials, to their paperwork. That is strictly based on the fact that the rent is more than the payment. So the rent for the property that they're buying is higher than the payment that's inclusive of the taxes and the insurance. And they typically don't do a expense ratio on the rent. So they won't go at 75% of the rent there. Just one for one. If the rent's $3,000 and your payment's $3,000, boom, you can get the loan. They even now have it where if your rent is $2,700 and your payment's $3,000, they'll still give you the loan. They just give you a higher rate. So less than 1-to-1. Yeah.
What's that state?
Say it again.
This work, for like properties out of state as well.
Yeah, I'm sure that I don't do out of state, but I'm definitely, I'm sure that they'll do them out of state. Yeah. So, and then the payments can get done interest only as well, which keeps the payment lower. And that still is the payment that they'll use. They are not doing these with like, they're decent down payment style loans, 25-30% down again on these types of loans. But a great way again for just getting the wheels moving on your investors. Okay, getting the wheels moving, getting the wheels going in their head. Hey, we have these alternatives. Obviously, if I can get them into the door and I can sell them a loan that uses their tax returns because the rates are way better, I will do that. But this again is just really helps in giving yourself some credibility. Hey, you know more about the lending side as well as the real estate side. So Bank statement loans, debt service cover ratio loans. Debt service cover ratio is how commercial loans are done. Okay, the rent eats all of the expenses. That's pretty much it.
The type of person is like gonna use the debt service.
A lot of investors, a lot of home investors. Yeah, the guy that I did for Pat was just a real estate investor. And you know, he got fuzzy on his taxes and didn't want to show his tax returns. And I just did this kind of loan for him and it was super easy. Okay. So you just make sure if you have any mortgages already that you pay those on time. And that you have insurance on those houses, that that you have mortgages, and that's really it. Okay. Yeah, they're not looking at, you know, they make sure you have the down payments as well in your bank statement.
Right.
Right. One big thing to remember on investment properties, sometimes gets missed and overlooked, is that gifts cannot be applied to down payments on investment properties. Okay. So if you're listing a property and this person is writing an offer and they're doing it as an investment property and they try to tell you that the down payment is coming from their brother, you know, that's not going to work. So call their bluff. Okay. Some of these loans, as you start to get into like the fuzzier world of loans, will probably start to be okay with that. But if it's just an investment property with, you know, a $400,000 investment property and the money's coming from a gift, you know, call the bluff. It's not going to work.
Crowdfunding type of thing.
I mean,
Like,
that
someone got all the cash through like crowdfunding.
that probably would not work. Because all those people now are interested parties into this purchase in this crowdfunding, and they don't allow that. If all of those people were on the loan, you could buy an investment property with your buddy's buddy. You can buy an investment property with 10 people if you want. Yeah, all cash, or you get a loan too. Everyone just gets incorporated into the loan, which you can pool money together and pool income and credit together for investment properties. That's definitely not out of the question. It's done.
If you wanted to, let's say a family member does want to help you, how long would that money need to be seasoned before you can then?
Yeah, like 2.5 months. Essentially, you have to show 2 months bank statements with that money sitting there. Yep.
No, and I was gonna ask, so you're saying people can all come together, but if they come together financially, but you know, only one person goes on title.
If you're on the loan, you gotta be on title.
Okay.
Yep. So you and I and Bronson find this rad house that we want to go and buy together. We put our taxes all in, we put our bank statements all in, they run all of our credit, we can get a loan together. You can put in 10% of the money, I can put in 20% of the money, he can put in 30% of the money. We can all be proportionate on our title, the way that we hold title, and we can do that. You can get together with a couple of your buddies, let's go buy this condo in Long Beach, right? You can do that. The guy with the lowest credit score is the one that's going to bring everyone down, right? He's just going to go off of the, you know, the least sexy client. But the income can get put together, you know, the money can get put together, and the credit score is used off the lowest credit score. So if you have some business partners that you want to start investing with, this is a way that you can do it. You can also do that for an owner-occupied property. Like you can sign on a deal where your buddy is going to move into it. You can be a co-signer. That doesn't necessarily have to be family. That's a segue. That's a different type of loan. But okay, questions?
Would that apply to FHA, like owner occupied, even if
It's more conventional. Yeah, FHA likes to have family members as co-signers. With like some sort of relation, aunts. But they're not going to go and hook up your family genealogy, right? And say that they're an aunt. Right, follow me? Or an uncle. Say it again.
Thank you.
Yeah. Okay, this is a really cool loan. Cross collateral loan. So this again is for this is when you're listing, you have like a listing that needs an up leg, and the listing that you have has a ton of equity in it. Okay.
Like wanted to use my house.
If you're gonna use your house, yes. The hard part about you wanting to use your house is that your rate on your loan is so low.
How about my rental property that's paid for free and clear?
That one will be hard because that financing of that property is hard because it's in the,
So own your own.
yeah.
Okay.
But assuming that it wasn't in on your own, or assuming that your house in the Ranchos was free and clear. You can now go and buy a second property and they take the two properties together and they do one loan across them. Okay, cross collateralized. You're putting two loans, or excuse me, two properties up against one loan.
Got it.
And they take the values and they'll give you a loan at 75% of the values. The total value, right? So you can essentially have a loan for more than what the purchase property is.
Ah, okay.
Follow me?
Well,
So they work really well, again, for properties that are free and clear. It limits or it allows someone to not have to deal with a contingent purchase a lot better, right? You with me? So they got their house for sale. They want to go buy another place. The house for sale is free and clear or has a ton of equity in it. We can just do a loan against that property plus the one that they're going to buy. And then you come back and you sell the other property that they vacated and you know, you're not rushed in selling that. Okay. They're all on arms. They do interest only. You can come back and then refinance the loan after the fact. You know, they work really well. They're just more for, again, like the ones that I've done have been on like beachfront style properties. Like they're just like tons of equity in them. People have quite a bit of money. It's not, you know, your regular like $400,000 condo that has 200 grand in it. You need more equity than that. You need more usable cash. So, but they're really cool loans. And again, just another talking piece, right? If you're holding an open house on an expensive place down in the shore or down in Naples or down in, you know, somewhere, it's just a talking piece. Do you own any other properties? Do those properties have loans on them? Well, you could use the equity of that place to buy the next place, to buy this place. Have you thought about that? And then we can go a bunch of different ways. You can use the equity. We can get a HELOC going on that other property, come and buy this place, right? So that's what they're ultimately for, is just to get, again, the wheels going on these people, you know, not necessarily do they get, like, is this the loan I do all the time? No. But it's out there. And it's, you know, makes you sound really cool. Use rental income, replaces current loan. That's why this loan would not work for the Rancho, because it takes out that financing that you have, right? You don't want to do that. Questions here?
You have a question in the chat from Brad.
Okay,
It says, does the cross collateral loan require an appraisal on both properties?
yes. It does. And it also would require rental appraisal on the property that you would be vacating. Let's say that it wasn't listed for sale and you were going to use the rent when you left it to go buy the next place as income. Not only do you have to get an appraisal of that place, but you have to get a rental survey of that place. And this loan requires, there really isn't like an equity stake in that property that you're leaving. It's just, again, it's a minimum of 25% equity across the two properties. But yeah, it's an expensive loan. That's another kind of shin kicker of this. You have to pay for multiple appraisals. You have to pay for the rent survey. The bank that does it just charges you somewhere between 5 and 10 grand up front to do it. So, but it serves a really good purpose when the timing is right. Any other questions? No. Fix and flip loans we have access to. They're just, you know, they're a little better than hard money style loans, right?
How are they better?
The rates are a little bit lower. Yep. And the LTVs are higher. They'll lend you more money. They just require kind of a lot of work up front though, again, right? You gotta have some plans, you gotta do some work up front. But it's essentially just, you're buying a house that's in disrepair. You have some plans, so they can, appraise that based off of what the house will end up looking like. And they give you a line of credit to do the construction, to pay the contractor, and you take it away. The loans, the payments are interest only, or a lot of the time, there's not even any payment until after a year. They just kind of balloon the payment on you, which at that point, unless the market has completely collapsed, you have sold it by then, right? So keep that in mind. That's your risk here. The one little weird thing that you kind of got to hopscotch around is that the rate that they give you is based on your experience of fixing and flipping. And if this is your first time, you obviously have no experience, so they're not going to want to lend to you very much. So that's where maybe we do the first one as a hard money loan, and then you come back and you start to do the fix and flipping loan after that. But they're really cool. They're really cool loans. Again, I don't do a ton of them, but they're out there, and you're listing a house that's for sale that needs some work, and someone comes in and they look like an investor and they drive a fancy car, and you can tell them, hey, we got some fixing and flipping loans. Do you want to talk to my loan person? Boom. Right? And again, it makes you look good. Yes, Lawrence.
I was gonna ask, so on the experience pertaining to the fix and flips, does that mean that you've never done as a licensed realtor, or you've just never done them?
As an investor. So this doesn't have anything to do with you as a real estate agent. This is more so looking at your experience in the fixing and flipping space. Have you purchased a property before that you fixed up and sold? And they can look at your tax returns, they can look at a closing statement. They somehow determine if you've done it before, to then be able to say, okay, we can take, this is a little less risky, so we don't need to charge this person 12% on the rate. We can charge them 10%, or we can charge them 8%. That's your rate is dictated a lot by the experience that you have in the fixing and flipping space when you do these loans. But it's a lot of like LTV style underwriting, where you're just, it's based on what they think the value will be after. They're not going to look at, a ton of your financials. They just make sure that you have the money and go from there. But, the part that is unfortunate is you need to have, a series of plans set out on how you're going to do the repairs. You need to have some budget, you need to have some plans, you need to have contractors that are willing to bite off on it.
Crazy Excel spreadsheet. if anybody needs one.
Donna, say it again.
I have a crazy Excel spreadsheet for that if anybody needs it.
Okay, cool. Donna said she has an Excel spreadsheet for budgeting and plans. Yeah. Hard money loans, again, this is the lending of last resort is how I phrase it. But again, if the house is beat up, or bad credit history, you want someone that wants to buy a house that just had a bankruptcy in the last 6 months or something, that's where these come in. They're LTV based, so you need to have a lot of money down, 35, 40% down at least on these. Rates are really high, 10 to 12% with 2 points up front, so they're expensive, but they get you in, you get the house, you fix your credit, and then we can come back and hopefully do a conventional style loan on the property. That's the goal. That's when people use these. Also, a lot of the time you'll find that land purchases are done with these style loans. Funky mixed use style properties are done with these style loans. They are going to have, a lot of the time they're going to have some prepayment penalties. If they don't, you can buy them out when you do the loan up front, but that's just going to become and increase the costs. But these are considered what are called business purpose loans. So These are typically only done again on investment properties. You don't see people giving you a hard money loan on your primary residence. So keep that in mind. It's because the TRID and QM and the different regulations, they don't like to see hard money. They're too expensive. The rates are too high for someone buying a house that they're going to live in. But you can do a hard money loan for 50 grand if you wanted to. You can do it for 500 grand. You can do it for $5 million as long as the house is worth enough. So keep that in mind. A lot of the loans for people that are in the marijuana industry get done this way, which is becoming more prominent, obviously. Fannie, Freddie, big jumbo lenders, Chase, B of A, Union Bank, they won't give you a loan if your income is still generated through the legal marijuana practice of California, because it's still a federal offense. So you have to go outside of normal financing means if that's your income generation. The bank statement loans you're able to do, though, that would be an example of a bank statement loan right there. Someone's got 15, 20, 30 grand coming in a month from their, their company, their building that they own that grows marijuana. Right. Questions? That's it. One of the things that I touched on that I mentioned at the last meeting that a couple people found very interesting was the process of talking to a client, a past client that you have. They bought the house in 7-10 years ago, or even 5 years ago, and they have a ton of equity and they want to continue to invest. One of the things we're doing right now is getting a home equity line on the house that they own to use as the down payment for the next place. Okay, it's a great tool to do. A home equity line works exactly like a credit card on your house. Okay, you don't pay on it until you borrow from it. There's very low maintenance fees of them. Some of the banks don't even have a maintenance fee per year, $75 to $100 per year, to have that HELOC just sitting there, have access to that money, to then, if the diamond in the rough comes up, you can get the money right away. A HELOC transaction is probably 30 days. So if they find that house and they don't have the HELOC set up, the timing is not going to coincide well. They have to be able to have it set up first, and then you find that house that they want to buy as an investment, come back, use the 250 grand from the HELOC to buy the investment property. That's the down payment. They have the HELOC in place. We get them the loan for the investment property. Bingo, bango. You guys get the investment property transaction. I get the investment property loan. Everyone's happy. But I would suggest this to any and all past clients that come to you that say, hey, I have some inklings to want to real estate invest, and I have this property that has some equity, but I don't necessarily want to do a cash out loan on that house because my rate on it is 3%, right? Well, you need to get a HELOC. A HELOC is exactly like a credit card on your house. You don't pay on it until you borrow from it. Just keep that in your mind. That's the best way to describe it. And it's very practical. If you own a house, you should have a home equity line of credit on it, 100%. Because it's just like a oh crap policy, right? If your kid hurts himself and needs to go to the hospital and you have access to quick cash, it's a really great tool to have access to. So that was another thing I touched on at the last meeting that, again, a couple of the agents found really interesting. Make some suggestions there that will, as prices start to come down on investment properties, they have the down payment. They wouldn't have access to that down payment unless they either did a cash out loan or sold that house, right? This HELOC is a great way for them to tap into that equity. Yes, Lawrence.
So on the HELOC, basically it's a reserve on the equity of your home.
Correct.
You say you don't start paying on it until you borrow from it.
Correct.
Is the repayment at the same interest rate as your home loan?
No. HELOCs are done using prime. Okay. Prime is a rate that's published in the Wall Street Journal. Prime today is 7. HELOCs are typically like 1 to 3% above prime. My HELOC on my primary residence is 0.75 above prime. So my HELOC is 7.75% today. My HELOC on my investment property is 2% above prime. So, or it's like 2.5% above prime. So the HELOC in the investment property is 9.5%. My rates on those loans are 2.75%. There's a big disparity between the two. But the HELOC payments are interest only for 10 years. So I can borrow, pay back, borrow, pay back, borrow, pay back my HELOC for 10 years. And then at the end of 10 years, if I have any money out on that HELOC, it converts to a 20-year paid back loan, principal and interest at the rate. The rate doesn't fix in at that point. So you get caught really badly with pants down if you're have money out on your HELOC at year 10. So don't have money out on your HELOC at year 10. That's the point. But up until year 10, they're a credit card. Use it, pay it back. Use it, pay it back. The rate is floating though. The rate is always going to be above prime, whatever that agreed upon amount is. And prime continues to go up as the Federal Reserve raises interest rates. Okay, but you can do it on your investment property as well. You can do a HELOC on your investment property. I'm doing one right now. So as you talk to those investors, you know, hopefully their tax returns are solid enough, but that's something that you would suggest. Great question. Anything else? All right. I mean, I'm seeing a lot of investment properties, and that's 1031 exchanges, right? These people have to buy a new place. They have to. You know, they can't wait the market out. So these loans are great for them. And, you know, they're trying to time the market a little bit. So they want to close in their trusts. They want to close in their LLC. You have options for that. Totally have options. The loans in LLCs are not as aggressive, but you have options for that. That's what you need to know. Cool. Any other questions, Sophia?
Nope.
Thank you, everybody.
Thank you, Alex.
You're very welcome.